What's up, you guys? Today I'm talking about how much house you should buy. Let's get after it. Hey, I just want to share some experience from my own life and what's worked for us. Hey, my name is Brendan. My wife and I bought a house about 3 years ago, and basically the rules that we followed are different than what the bank would have allowed us to do. So whenever we were thinking about getting a house, I went to a mortgage broker and told him what our maximum mortgage amount would be, and he worked from there. So we never actually even found out like what the bank would give us, because banks typically lend you right at the limit of money between you failing and like going bankrupt and you just barely being able to pay. And we didn't want to put ourselves in that kind of a risky situation. And so I didn't even want to hear the potential awesome amount of money that we could spend on a house, because I figured that if we saw those houses, we would want them and we would go buy them. So it was sort of like, put on the blinders, don't let me see, let me just pick this cheap house out. So specifically, the rules that we followed were Dave Ramsey's rules. And his rules are: 1, 15-year fixed rate mortgage. 2, have 20% down in cash at the time of purchase and use it. 3, the mortgage amount, so the monthly payment amount, is equal to or less than 25% of your take-home pay. So basically this is inflicting upon you some rules. And if you're like me, you're not a big fan of rules from some stranger on the internet or on the radio telling you how to live your life and what house to buy. But I'm really glad we followed his rules, and here's why. Over time, whenever you start to put this stuff into a calculator online, you realize how much money you're saving on interest by doing a 15-year mortgage, by putting 20% down. Like, it's
massive.
We are saving, by doing it this way, of a 15-year mortgage and putting 20% down, we're saving close to $100,000 in interest. And that's just insanity to me. Of course, there's people that will get into the nitty-gritty of things like, oh, it's an inflation hedge, and what if you'd invested that money instead of spending it on your mortgage, and all these different things. And those are viable arguments. But for a conservative approach to your primary home that you're going to live in and require to be a healthy, functioning human, I mean, I think it's worth taking these steps to be extra conservative, to make sure you don't lose it, to make sure nothing bad happens. The other rule of limiting how much house you buy to only 25% or less of your take-home pay is tough to swallow, because whenever you compare yourself to everyone else, and that's unfortunately what we do all the time, you see how much house they're buying, and it is a ton of house. Like, for the income level that you're at, going from what the bank will lend you all the way down to 25% or less of your take-home pay is such a monumental shift. Like, you're not quite cutting it in half, but it's pretty close to cutting it in half. So if you were looking at $600,000 houses, now you're talking about like $350,000 houses. And that's a massive difference where we live. I mean, I assume it's a massive difference pretty much everywhere, but my gosh, it is a massive difference. And so we did it the opposite. Like I said, we set a hard limit. Our limit was $250,000. We're not gonna spend any money over $250 unless it's like the most perfect house. But that was our self-imposed ceiling. We found a house for $232. We pulled the trigger. We never looked back, except that I had a little bit of regret in my heart. I was like, what could we have bought? What would the bank have lent us, and what kind of house would that have bought us? Basically, it would have got us into a nicer neighborhood, a little further on the north side of town, a little bit bigger house, a little bit newer house. That would be nice. I'm not saying that more money doesn't buy more house or more benefits or a nicer school district or whatever. It generally does, and that's valuable to your life. It's great. But the problem is, when we trust our lender to tell us how much money we should be giving them, we're putting all that power in their court. They are the ones that benefit from you maxing out that mortgage limit. They're the ones that are making the most possible money off of you without you actually defaulting on your mortgage. And there are people right now who are defaulting on their mortgage because of the worldwide virus. I won't say the name. Worldwide virus and its impacts and what's going on. There are people losing their houses. And if they'd followed these rules, odds are there would be less people losing their houses. So all this to say, you set yourself up for a more secure footing if you follow those 3 rules. I'm not saying you have to. I'm not saying you follow them all to a T. I know there are people who are following 2 out of 3 rules whenever they shop for a house. So they're going for 20% down, which helps you not have to pay that extra private mortgage insurance money, PMI. PMI, if you've heard of that. That's great for everybody. 20% down is awesome. You're not paying any interest on that money because it's not part of the loan. Like, it's literally not in there. So that's the way to save the most money, on interest at least, is to have a bigger down payment. A bigger down payment can also make your lender feel a little bit more secure. So maybe you get a lower rate, like that's really great. And the 25% or less of your take-home pay for your mortgage payment is pretty easy to figure out, pretty easy to get under, especially if you sacrifice the third rule of the 30-year mortgage versus 15. So the three rules really work best and ideally when you're making a relatively high income, like an above average income, or you live in a really low cost of living area, or both. Because for us, even at the time that we were shopping, we made less money than we do now, but our combined incomes, I think we're right near at 100,000, which is well above the median income for the United States and well above the median income for Arizona. And so we had more headroom to play with there than most people even do. And still the houses that we were looking at the time were either really kind of sketchy, or they were out in really rural areas, or needed a lot of work. We kind of lucked into the house that we found because it was right at that limit of like, if we needed to, we could live here comfortably and not change anything, but we would like to remodel it. Like, it needs remodeling. And so I realized that some of these are kind of idealized rules. If you make $40,000 a year and live in Southern California, like, these rules just don't work. You know, they can't apply to you. And so depending on the area that you're looking at too, and your tolerance for risk, you could potentially sacrifice one of the three rules, still be really conservative, still make good decisions overall, and move on. Because the overall goal is for you to create more margin of available finances for you to do whatever you want with, like have fun, for you to invest with, because that's really important. I'm gonna talk about that in more videos to come, but the earlier you invest, the more time it has to grow, the better that is for you. And in general, it's a security blanket, because if you lose your job, you get furloughed for a while, whatever, you have other debt to pay down, it leaves you more headroom to do that stuff because not all your money is going towards your house. So what's my recommendation to you? I would say overall, don't trust the bank to tell you how much house to buy. Just saying, there's a little bit of a conflict of interest there if the person that's making money off of you is the one who's telling you how much money you should spend. So what are other benefits of buying the cheaper house? Well, it's actually been studied that if you live in a cheaper neighborhood, so like if the median income of the people in your neighborhood are lower, you end up spending less money because your norm, like your normal sense of what people spend on cars and on their house and on their clothes and on their kids' toys and the other things you just sort of subtly, subconsciously pick up on, that being lower means that you don't feel as obligated to buy as nice of stuff. And it's probably not something that you consciously like ruminate on all the time. Like, man, that guy's Range Rover needs to be my Range Rover. Or he's got a white one, I should get a black one. Like, we don't necessarily spend a lot of conscious time thinking about that stuff, though I do think about it and I do compare. I try and let it like kind of roll off my shoulder and blow it out of my mind. But when you're in that really nice neighborhood and people are either making a lot of money or at least spending a lot of money, that just becomes your new normal. Like your average gets reset to a higher level. Your average level of consumption that you see, your lifestyle average goes up. And then you go, well, maybe we should shop for a couch at Copenhagen instead of the furniture store down the road, because Johnny and Susie over here have all Copenhagen furniture and that's really nice. I like it now, where you would have been perfectly happy with a good couch from the furniture store down the road. So I kind of liken it to cars because I really like cars and sports cars and driving. Whenever somebody has a cool car that they want to go fast in and they modify it, let's say they add like 30 horsepower. You got your Mustang, you add 30 horsepower. Whoa, feels fast now. This is so crazy. A few weeks later, oh yeah, this still feels good. A few months later, yeah, this is just my car. I mean, it's just normal. You've acclimated to that extra power. It's like your new normal gets reset. So then that person with that car goes to modify it again because they want to feel like excited again. I want to feel like this is a new, good, powerful thing again. So they add 30 more horsepower or 100 more horsepower. Perpetual chase happens for that feeling of newness and goodness and excitement and all of that stuff. We're chasing that buzz that we got the first time because we just keep acclimating. So that's what's happening with our level of like perceived lifestyle and perceived okayness. Is the nicer stuff we're exposed to, that average level gets reset higher and higher until it's like the bare minimum we can live with is really, really nice. You know, that's happening to all of us on some degree or another because we're not like riding horses to work or walking or, you know, living outdoor in some like tent, but A couple hundred years ago, that'd have been fine. And our DNA hasn't changed that much. Like, we're just used to this level of expectation and lifestyle that we just expect it. Like, our expectations are pretty darn high. So, should you buy less house than the bank will let you? Yes. Should you follow all 3 Dave Ramsey's rules? If you want to be ultra conservative, then yes. It protects the rest of your income to do other stuff with. If you don't really care about that, if you're interested in getting the most house you can possibly get into, and you're okay with being leveraged, you're okay with chunking upwards of 50% of your pay into that house, it's your house. Like, do whatever the hell you want. That's what I say. You know, I'm just a guy on the internet. So if you've got to have that really nice house and you believe that you're gonna make more money in the future and you can make it happen, go for it. Like, I'm not gonna tell you how to live your life. Just gonna share my own personal experience. I'm glad we did what we did, and there's a chance we'll even pay it off earlier than that. Right now, we're about 2 years ahead of schedule. So we might be mortgage free in 13 years, and that will free up our cash flow, which I would really like. So it's just a matter of preference. Like, most of this stuff with personal finance is a matter of preference. How risky do you wanna be? Where do you want your money going? What kind of lifestyle do you wanna live? That's about it. Thank you for watching. This is Brendan, Fitness and Money. I'll see you later. Bye.